move on to big letter B in the middle of page 2. So let's think back to the early 80s, if you can. Maybe you studied it in school. In the early 80s, do you know, did somebody tell you, or did you get to live through this? What was the prime rate in 1980? Any guesses? Is it what it is now? No, it was really high. In the early 80s, the prime rate was 21.5%. And here I am, the insurance producer, and I come to your door. Hello. Hi. I would like to sell to you, for you to purchase from me, traditional whole life. Now remember, it's 1980 and prime at the bank, 21.5%. I promise to pay you 4%. What are you going to say? No, thank you. You're probably still going to buy term insurance, but you're going to take the rest, put it in the bank in a certificate of deposit, and nobody was buying these traditional products anymore. So the insurance company had to invent what is called universal life. UL, universal life. Number 1 and number 4 at the bottom of page 3 are the same thing. Universal life is sometimes called interest-sensitive whole life. Interest-sensitive whole life. If you have a client that wants to buy a product that is tied to the current interest rates, you will sell them universal life. Universal life is more popular in times of higher interest rates. It is tied to interest rates. It works differently from anything that we've discussed so far. The first thing that makes it different is it has 2 death benefit options. Death benefit options A and B. Death benefit option A pays out when you die, the policy's face amount only. Death benefit option B costs extra. It pays out when you die the face amount plus the cash value. So this is something that we have never heard about before. So universal life, death benefit option B pays out the face amount plus cash value. So how does this work? Universal life does not have a fixed premium. It has what's called a target premium. So that if interest rates were to change dramatically, the insurance company could raise your premium. So that is important to remember. It is not fixed, it is a target. And what happens when you have universal life is you pay this target premium, let's say it's $1,000, part of your premium goes in to buy you term insurance. Term insurance is death benefit option A. So of my $1,000, I'll be age 30. Let's say $100 goes in to buy me my face amount. Face amount, $100,000, just as we've always talked about. The difference, the rest of it, goes into my cash value. So here's the $900, which is now going to earn a current interest rate. So it has a current rate that's guaranteed for 1 year. And let's say it's 1980 and it's earning 18%. Now the current rate's going to stay the same for 1 year, and then they're going to adjust it from every year after that. This cash value is still in the general account of the insurance company, and they promise to never pay me less than the minimum guaranteed interest rate, which we already learned that we're always going to say 4%. So this is different. If you have death benefit option A, what's paid when you die, the face amount. If I've paid extra for death benefit option B, what's paid when I die, the face amount plus whatever I have in my cash value account. Now, over time, what happens, I get older, and more money has to go into buying me term insurance. Statistically speaking, I'm closer to dying, hence term insurance is more expensive. Hence, less goes into my cash value every year. Now, what happened to interest rates since the early 80s? Thankfully, they've gone down. So It didn't earn 18% forever. Every year it's gone down since then. One of the marketing tools that they used when this product was new is they said to their clients, now you would not say this today, you would explain it fully exactly how it works, but what was said was, hey, pay into this policy for 10 years. After 10 years, you don't have to pay anymore. You can debit your cash value, which is true. You can do this. You can debit your cash value, and you can use it to pay your premium. And it is not a loan. That's important. To take money out of your cash value on a universal life policy is not a loan. You can do that and you won't have to pay it all, and you'll still have your protection. You'll still have your policy's face amount. So people did that, and they did that, and they did that so many times. Interest rates were falling that they ended up left with zero in their cash value, and they didn't really understand that their face amount was term insurance, and then their premiums got really high. So I'm not saying that you would ever say this, but it is true to say that it is flexible regarding premium payments. If you would like to debit your cash value and apply it to your term insurance premium, you will still have the face amount, because the face amount is made up of term. Would you have less paid out if you've been paying for death benefit option B? Certainly. So if you have no cash value left, well then there's nothing to be paid there. Death benefit option A is the face amount only. Is the premium fixed? No, it's a target. If interest rates change, could they ask you to pay in more? Yes. Universal life is tied to what? Interest rates. It's also called interest sensitive whole life. Now we get to go on to a product that is tied to stocks. And that is number 2 at the top of page 3. Variable whole life is tied to the rate of return found in the stock market. If you were going to sell a variable whole life product, you would also need to have a securities license. So variable whole life is the first product that we learn about that is regulated not only on the state level, because insurance is regulated state by state by state, because of the McCarran-Ferguson Act, but it's a variable product as well. Variable means that it invests in securities, and securities are regulated federally by the Securities and Exchange Commission. So it's dual regulated at the federal level, the SEC, and at the state level because it is an insurance product. Variable life is tied to stocks. Tied to stocks. To be able to sell it, I already referenced, you have to have a securities license. In order to have your Series 6 or Series 7, you have to be registered with the NASD. Your Series 6 is your Mutual Funds and Variable Products license. We have an online course for that. Or you could have your Series 7, which is your stockbroker's license, and we have an online course for that. And you need to have a life and variable authority. It's no separate test, it's just a different license that you would get. When you sell variable life, the premium payments do not go into the general account. They are kept somewhere separate. They go into what is called the separate account of the insurance company, which really acts like a mutual fund and invests in the stock market. So who has the risk in the separate account? The insured, the client. What's the guaranteed rate of return in the stock market? I wish. There is no guaranteed interest rate. So the premiums for variable life go into this separate account. The client takes on the risk. We do not know what the client is going to earn. They need to understand their cash value is variable. Now, an important point to make, because we heard adjustable whole life had an adjustable premium. Variable life has a variable rate of return in the separate account. Its cash value is variable. Its premium